Hello, everybody. My name's Matt Roy. I'm with Blue Ocean Benefits and Consulting and also AmericasInsuranceGuy.com. Today we're going to talk about self-funding. Just a short video on the basic concepts of self-funding and level funding. We'll have future videos that go into some real detail. If you really want to understand self-funding for a small or mid-sized business, you're going to want to watch all the videos as they come out. So this is our very fancy drawing of what's going on in a self-funded plan. A self-funded plan is actually a little bit of a misnomer. No medical group plans are actually self-funded. They're always covered by reinsurance. A rep a long time ago said to me, a self-funded plan is a fully reinsured self-funded plan. I think that's one of the first misnomers or first problems people have with it. They think that self-funded, there's a lot of risk. There is more risk than a fully insured plan, but there's not an unlimited amount of risk. So a fully insured plan, that's what FI stands for. If you have a group medical plan for your employees, it's pretty simple. You pay a premium to the carrier. 100% of that premium goes to them. They keep it regardless of what the claims are. Pretty simple. You know how that works. The two policies I'm going to talk about are a level funded plan and a self-funded plan. Okay. Again, self-funded, not totally self-funded, but more so than this. You could have a fully self-funded plan. A very big company could take the risk on 100% themselves, but you won't see that in in anything under 1,000 lives. But a real popular plan right now is like what's called a level funded plan. It kind of combines the best of a fully insured plan and the best of a self-funded plan. We'll get more into other videos about how you get in and out of these contracts. We'll get more into how they show you claims and all of that stuff. So today we're just going to talk about the real basics. A level funded plan has a bunch of different parts. You have an administrative part. That's the part where you're paying a fixed fee for claims adjudication, for network usage, for second surgical opinions, for prescription network, things like that. So there's a fixed amount of money that you're going to pay every month per contract or per employee. That is not going to change regardless of what the claims are. So that's your admin cost. The next two are a little tricky, and this is where a lot of people get a little confused, but these three costs, admin, ISL, and ASL, are what we would constitute as our fixed costs. These are the fixed costs for a plan like this. You would pay the fixed amount every month for an employee. You add more employees, you're going to pay more, so it's not a fixed number, but it is a fixed rate, okay? Individual stop loss, that is reinsurance, okay? And what that is that says if you're going to pay the claims for your employee, because that's what we're talking about, self-funded, an individual stop loss is where you get reinsured for a claim. So for example, if you have an employee that is sick and in the hospital and they have a $100,000 claim, if your ISL is $30,000, then the first $30,000 would be yours, and after that the next $70,000 would be paid for by the insurance company. When it's a level funded plan like this, it's always one company doing this. We write a lot with Cigna, Aetna, United Healthcare. They all do these sort of plans. Depends on the state where you are, but a lot of them do these plans down to 25 lives. So the individual stop loss is a piece of insurance inside the contract that says for every member in your group, employee, spouse, and children, their claims can't be over a certain number. Once the claims go over a certain number, this kicks in and it's not in your contract. Okay, so if you have a $2 million claim, you only pay $30,000 for that in our example. So it's not an unlimited risk on that one claim. That's a very important part. And in one of our next videos, probably the next video, we'll actually break down these numbers for a real group so you can see where this comes. But obviously this isn't a huge number, but this can be a big number because you're insuring, a big claim past $30,000. An ASL, aggregate stop loss, that's a different number entirely. That is all the 30,000s that you could possibly have added up together. So in other words, if you have claims and I have a $5,000 claim and Derek over there has a $10,000 claim and John behind the camera has a $50,000 claim, John stops at 30, Derek's is 10, mine's 5, total there is 45,000. That's what we insure here. That's called an aggregate number, and that's so that you don't have a bunch of little claims pile up and go over a certain number. If you go over that number, which we'll talk about in a future video how we calculate that number, then that insurance kicks in. So you could have nobody hit your ISL and still hit your ASL. It doesn't happen very often, but or you could have just 4 or 5 people hit the maximum, and that causes you to be real close to your maximum claim. So within this contract, you're paying for 2 pieces of insurance. You're paying for the insurance company to administer the claim. you're paying for them to reinsure you on an individual basis for your employees, and you're paying for overall. So you know your maximum for each person, and you know your maximum for the group. The fourth part of these claims, and they are the claims that are beneath the ISL. So they are the $5,000 claim, the $10,000 claim, the $50 claim. So when you do a level funded plan, the carrier calculates in their mind what they're going to need for admin, ISL, ASL, and claims. They then usually charge you about 25% more than they expect it to cost, and they give you a flat number. So it looks like a fully insured premium. Here it is, but it's not, because the claims are actually being tracked and being looked at. And at the end of the year, if your claims ran here, depending on the contract, they'll either give you back some of this or all of it. They'll split it back with you. And we'll talk about how they make money and all that in a future video. But basically, they give you a policy that looks just like this, but it really is broken down just like this. And they give it to you at the price, and maybe in some cases the same as a fully insured premium. Now, a self-funded plan is just like that, and we don't have to go through these first three things. It's just like that. The difference, though, is that your claims could be zero or your claims could be a maximum number. You don't have a fixed maximum number that you're paying with the level funded. Here on a level funded, you pay this, even if your claims are here, and then there's a mechanism to refund some of that money. On a self-funded claim, if you didn't have the claims, you would never pay it. So the first month you might pay this, the next month you might pay this, the third month you pay this, then the fourth month you pay that. So you're actually just paying the claims as they come. The advantage is at the end of the year, you won't have any truing up to do with the carrier. But the disadvantage is your numbers are all over the place. It could be a low number, it could be a high number. All of these plans have ways to get out of the contract at the end of the year, and we'll talk about that. A fully insured plan, you just can end the contract on January 1st or whatever, and you're out of there. On a level contract, usually you can do that too, but on a self-funded, somebody's got to pay the claims that come in after the contract ends. So we'll talk about that in a future video. But this is basically self-funded. This is a fully insured premium. A level funded looks just like it, but has all these components with a maximum claim amount that you're going to pay. And a self-funded one has this variable claim amount. So fixed costs, variable costs. So watch some more of our videos for more of the details. I'm Matt Roy with Blue Ocean Benefits and Consulting and America's Insurance Guy.